One thing that's been really grinding my gears this past week, as someone who has not left Twitter for blue sky, has been seeing all the celebration around Elon Musk's Doge Commission. And so I think we need to actually shine some light on what this is really going to do, because it actually has significant implications for the bond market. One of the promises made on the campaign trail by the Trump administration or the Trump team was that there'd be substantial spending cuts, and outsiders like Elon Musk and Vivek Ramaswamy would come in and identify where those savings could be made. Now, given the news flow over the past week, given the cabinet appointments and the planned executive orders, this is still clearly a very fluid situation. But given what we know on November 19th, this is what we can say about this big spending cut risk to the U.S. economy, and ultimately something that could help the bond market moving forward. The announcement puts the Department of Government Efficiency into the function of a deficit reduction commission, no different than Simpson Bowles. A blue ribbon committee is something that does not have any statutory authority. As Radigan recently put it on an episode of Overtime, it's like if the Biden administration hired McKinsey or Boston Consulting Group to advise on a problem. Because this group has no statutory authority, it means that any of the measures that they recommend to the Trump administration would need to be passed by Congress for the most part. So let's think about the timeline here for these spending cuts, as Trump has announced that he wants these cuts and the announcements, or at least the recommendations from the Doge Commission, to come down the pipeline by July 4th, 2026, right in time for America's 250th birthday. But the funny thing about the timing of America's 250th birthday is about 3 to 4 months prior to the midterm elections where the incumbents party typically loses between 20 and 23 seats. So if you apply that law of averages to this situation, it means that Democrats are likely to take back the House in 2026. And so do we really think that the Trump administration is going to give Congress and congressional Republicans in purple districts a laundry list of spending that they need to cut that will ultimately drive the economy into recession in the short term? Probably not in 2026. So if the Trump administration and if this Doge Commission is really going to bring about these substantive spending cuts and reforms that have been promised on the campaign trail, realistically, they're not coming down the pipeline until 2027 at the absolute earliest. And so for a bond market that's struggling on the other side of the election to figure out what matters most, is it the threat of mass deportations and what that could do for the food supply and food prices in the country? Is it the tariffs and what that could do for the cost of imported goods into the country? Or maybe it's something big and deflationary, like spending cuts coming down the pipeline. Well, I think that marble's been taken off the scale, at least for the foreseeable future. And so while Musk and Ramaswamy may be running around and posting ridiculous tweets like we've wasted $900 billion last year and ignore the fact that $680 billion of that are interest payments that we can't just stop paying, well, the spending commission is really not going to go anywhere. It's just like Simpson Bowles. It's a good idea. We do need to reduce the deficit. We do need to bring down our debts. And yet the form and function of this happening probabilistically seems null. If only to put it into simpler terms, the Doge Commission seems like a bunch of dog shit.
Okay. What's your question?
Well, the explanation is that for bond market traders, all this talk about spending cuts and weighing that into your fiscal trajectory, we've been having this conversation, Victor
Sure.
and I, Dylan and I, Jamal and I think this is noise. There is absolutely no signal here. And anytime we see any bond market strength on any McKinsey or Boston Consulting Group like study that's coming out saying we need to reduce the deficit, it is just bread and circus. It's actually a distraction. It's nothing that bond market traders should be concerned about. They should be concerned about the fact that the Federal Reserve here is making two different changes moving forward. This really didn't get discussed all that much last week. But Powell acknowledged that they may move away from their average inflation targeting. This is what they did during the pandemic that gave them the flexibility to allow inflation to overshoot. That means they're going to take a more rigid approach to sticking to the 2% target moving forward, perhaps. And if they do that, coupled with a Fed rate path now that's only expected to deliver 3 more rate cuts moving forward, the bond market doesn't have that tailwind that we thought it may have had a few months ago, unless you really think recession is on the horizon right now. So as a bond market trader, as someone who's been trying to trade this directionally, I think that playbook is totally in the garbage at this point in time. The playbook now is if you do see any rallies in bonds, given the elevated volatility environment, we see the IVRs have gone back and forth from the high 80s, 90s down to the low 20s or 30s. If we can get IVRs back in the 40s, 50s again, that is an environment where we should be looking to take those directionally neutral trades because in terms of directionally positive or negative outcomes here, there's not much by way that's going to push things around that hasn't already been priced in. And I hate to say that as a bond bull. I was really bulled up on bonds for a lot of this year. It looked like it was working out up until October, but we need to throw away any past pretenses we've had because the situation is now in a completely new world.
Didn't you correct me if I'm wrong, because you know these numbers a lot better than I do, and I'm only going from memory, and my memory is not that great. I think Trump raised the debt ceiling by the most by any president during his last administration, only surpassed by Biden this time. Is that correct?
I think every president since
the dawn of time,
since Clinton has seen that, right? So it's like Bush, and then Obama set the record, and then Trump set the record, and Biden set the record, and guess what? Trump's going to set the record again here because that's just how we would do things in America.
So I have a different take on all this. I don't actually care about all the things you just talked about. I mean, it's a nice soundbite, but I don't understand why you think it's relevant for trading.
Well, the bond market's telling you a little bit something about interest rates. Then
the bond market is an interesting trading vehicle because it's deep, it's liquid, it has decent volatility, and it is very it's very tradable. Let's put it that way. And based on where it's trading relative to where it's been, that's the most interesting thing. Trying to guess what's going to happen in 2025 or 2026 or 2027, and trying to think like you're thinking about based on the history of the last Trump administration, the chances of Elon Musk having any kind of a role in the White House in 2026 is probably less than 25%. I mean, he's got a better chance. I don't want to say, I don't want to be.
That's just your personal.
I understand.
Nobody knows.
Nobody knows is my whole point.
There's actually a Kalshi market for that right now.
I'm sure there is.
That's great. Now that's news.
It's that because if I was making event-based markets, which I hope that we are next year on Tasty, that is something that I would list because I don't think he'll be around.
Oh my God, we're gonna get creamed.
But I don't think.
So Kalshi says 44% chance that he leaves the Doge Commission before 2026.
Of course, and I think that the same thing with Vivek and the same thing with half the other people. The most, it's kind of funny because I think of all the things that I hate about Trump, which is like too many to list, there's a few things he does which I think are really interesting. The way he plays I don't know if he's playing Musk and I don't know if he's playing these guys, but some of the moves that he made with his appointments for this, for this administration, I think they're very strategic. And I don't say that in a negative way. Like, I think the most interesting one, and I don't want to go off onto a political rant, but I think the most interesting one is Matt Gaetz, because I think that he knew exactly what he was doing and he was repaying loyalty, and he knows that he has no chance of getting
nominated,
getting approved.
Yeah.
But yet he paid his debt for loyalty, and then he gets to put in the person that he really wants. I have no idea who that is. And so I think he's very shrewd in that regard, that he plays these guys. I think he got a lot of political...
Or he's getting good,
I think he got a lot of really good political bandwidth out of Elon, but Elon won't be... Elon is not able to cut it off. Like a couple of years ago, Elon was an amazing entrepreneur. I don't know what he is today. I really don't know what he is today, but I wouldn't invest in him today with your money. And so I don't think he'll be around when push comes to shove. He's insatiable, and he's not going to stop. And Trump will not want to yield. So I don't think Elon's going to be around. As far as cost efficiency, I think that's a no-brainer to create a committee to do. And I think it's way more interesting than hiring McKinsey or some consulting firm. I think it's a way more interesting approach. The problem with it is that as much as we like to think that the federal government is just one pile of waste on top of another, it actually is pretty efficient. And yeah, I'm sure there's, a couple $100 billion in there, maybe even $1 trillion that ultimately you can squeeze out. But you got to be really careful because we are an economy that continues to grow. We are an economic machine. We are a global powerhouse. And the last thing you want to do is disrupt that momentum. You know, we don't need the margins we don't need huge margins to make this country work. We just need to keep the momentum going. So I think he needs to be careful. I think he needs to be really careful. And I think he needs to give the impression and actually, you know, to a certain extent, create some kind of a cost savings. But I don't think you need to gutting our economy and gutting our growth would be a massive mistake. The stock market will crater if that's the case.
You know, Sadnop, you ask for the world and you settle for change.
Well, that's what I'm saying. It's posturing. I think it's an interesting strategic move.
Yeah, right.
I don't think it's a realistic move.
Well, I think that's the point I'm getting at here, right? And I know when people in the chat all the time say don't get political, who's in the position of power controlling the economic levers of the economy? It impacts the bond market, impacts the equity market, it impacts flow of capital across borders, right? So we have to figure these things out. And trying to do this in a sober-minded manner is ultimately what's important, because as I've been beating on and bleeding on about for the past several months, the Democrats that listened to Paul Krugman in 2016 got their clocks cleaned, and people that were listening to Vivek on August 5th saying there was the Kamala crash got their clocks cleaned. So don't put any politically on a pedestal. But you think about the composition of the appointments, right? The net gain in the House for Republicans may be 1 or 2 seats on the other side of this election. That's a really thin margin still. And if you think about how Trump's been proceeding moving forward, the one pick that he has not rushed into making, as Tony joked at the top of the show, is Treasury Secretary. If he wanted someone to come in there and just be Mr. Tariff and fire these bazooka tariffs left and right, as opposed to doing it with a scalpel, he could have made that announcement on day one. He's clearly trying to choose someone that the market respects, that the market feels is going to do things in a precise manner, not to upset the boat or rock the boat. Now, in terms of that composition of Congress, we're not going to get anything more than a continuing resolution for the first 100 days of Trump's term. Mike Johnson, the Speaker of the House, announced that they really can't do anything, and they're going to try to just push the spending through until March.
I agree. They won't do anything for the first 100 days.
So when you see the scope here, now we're trying to map out the timeline for these things. When would the Doge Commission actually deliver the recommendations for the big spending cuts that could upset the economy? When do we see Trump's fingerprints on a budget? You're probably not talking until March at the earliest, maybe April. And then you start to think about the Trump tax cuts that were put into place in 2017. So fiscal policy doesn't really change now moving forward for a good chunk of 2025 at the absolute earliest, probably well into 2026. I think the bond market, it's been reacting to all these news and information in recent weeks.
I don't know. I got a nice time spread on Kalshi for you. Sell the before 100-day at 25 cents. Buy before the end of the year on Doge for 50 cents. You do that for a quarter. If you get past 100 days, you're in for the end of the year, for the end of 2026 for a nice 50 cents. I mean, a nice 25 cents. I like that spread. That's what
25 cents? You like that spread?
Yeah. 3-to-1 odds for till 2026. Before July 2026.
What's the other side to that?
100 days, May 1st, 2025. So he's got to stay on from May 1st, 2025. You win that 25 cents. You paid 50 cents for the back month. Net, it's a quarter.
So you're saying he will make it the first 100
He'll make it to the first 100 days. He won't make it to 2026.
So you're
intelligent trade there, 3-to-1 odds.
Yeah. I wonder if you can, I wonder how much you give up to make that trade.
It looks like it's 25.80 in the front month, so it's a nickel, and it's 59 now, 44. So about a nickel, 10 cents total.
10 cents. 10 cents, which is 10%.
Yeah, 10%. It's like the guys on 71st Street and 13th Avenue in Bensonhurst, Brooklyn.
Yeah, that's a lot.
That's correct.
I mean, 10% to make 10% to make 25%.
If it
you won't max
50 if it works. Yeah.
You won't max.
Yeah. Right.
But you give up 10%. That's a big fee.
Yeah. Well, it is what it is. I don't know. Don't shoot the messenger.
Okay. I do like it. I mean, I like the way you're thinking. I don't think that market's really tradable. Yeah. But I hear you, Chris. I just, I think the play here, honestly, is you have to kind of put tape over the whole political scene and just think about, these positions. I really think they're pot odds plays.
Sure.
And, the bonds at these levels are just interesting. That's all there is to it. There's more upside than there is downside. That's just the way I look at it. And everything else is just, if you want to go the noise route, there are so many noise plays right now that I think that's the most interesting piece.
Yeah, I think the genesis of this conversation is really, I've heard a lot of people say, and I've read this on Twitter and in podcasts, bonds are well positioned here because all these spending cuts are coming down the pipeline and they're going to be deflationary. And that makes sense, right? If bonds have, at the long end of the curve, if you're looking at notes or bonds, have an inflation premium embedded within them, well, then a big chunk of government spending disappearing should, in theory, be deflationary. So bond prices would go up as yields come in. So I just wanted to address that. If people are listening to that narrative, probabilistically very low of occurring anytime soon.
Yeah, I don't care what the reason is, but I will tell you too. What is also interesting here is that because bond volatility is pretty high, the out of the money, some of the out of the money puts in like the 10-year notes and stuff, they're still a little bit rich in my opinion.
Yeah, Ivy Rankin 31's pretty good in there. We've just had a 4-day rally in the notes too.
Oh, I know we have, but last week they kind of, I feel like they bottomed out. They bottomed about a little bit, but the juices got bid up on the notes and on the options.
Yep.
They're pretty liquid, and so anyway, I've traded a bunch of them in the last week. That's the only reason I know, and I think there are more than a few markets like that right now. So just they're pot odds plays. The political stuff just keeps the volatility high, which is what you need to make some money. I love all the politics around all this because it keeps vol just, it keeps enough juice in here.
Yeah.
I think the good thing is that we could have an interesting December and January now, because not that there's any risk to a peaceful transition. I think it's more that there's just a lot of uncertainty, which makes it really, the first 100 days are interesting from a trader perspective.
I think one of the big considerations for me going into the first part of next year is if we're going to see an extension of the TCJA, or maybe because the Republicans have a trifecta, we're going to see capital gains rates lowered in the future, right? Would that inspire some people to do some tax loss harvesting up front to get that done early 2025, as they may have held their positions after the election? And that leads to somewhat of a pullback, right? Because if you think you're going to have a lower tax rate in the future, harvest now while you can get the maximum tax benefit as opposed to waiting.
You mean a higher tax rate in the future? You mean higher? Why would you? Were you saying higher or lower?
No, I think Trump is going to reduce capital gains taxes moving forward.
So why would you?
So he's saying sell out your crap now. Why would you want to take the?
And why would you? Are you talking about taking losses?
He's talking about taking losses,
yes.
Tax selling for the
got it.
losses.
Okay, I thought you were saying profits.
So that you can have more gains in the following year. And
okay.
then.
Sorry, I just misunderstood what you're saying.
Right.
I don't think people. It's entirely possible. I think the other
it's
side.
One of the multitude of things that people are considering, right? But it's just one thing in the back of my head. How are longer term investors structuring their flows at the end of the year with respect to this very particular issue? Yeah,
I can tell you from experience, most people don't think about harvesting tax losses unless you're in like a fund, a mutual fund or something like that, and the manager's harvesting losses because against profits they have to take. Individual investors rarely harvest losses to offset tax changes. They will harvest losses to offset gains, but not tax changes. On the positive side, if you lower capital gains, they will definitely wait until the lower price goes in play. Definitely.